N. Calculate a sales mix variance and explain its impact on revenue and contribution margin. Sales mix variance measures the effect of changes in product composition. It isolates the impact on revenue or contribution margin caused by selling products in different proportions than originally budgeted, holding total sales volume constant. The calculation compares actual mix to budgeted mix using standard contribution margins or selling prices. Impact depends on relative profitability of products. If higher margin products represent a larger proportion of actual sales than planned, the variance is favorable. A shift toward lower margin products produces an unfavorable result. Managerial insight supports strategic adjustments. Understanding mix effects helps evaluate marketing effectiveness, pricing strategy, and product emphasis decisions to optimize overall profitability. O. Calculate and explain a mix variance. Mix variance evaluates changes in input or output proportions. In manufacturing, it measures the cost impact of using materials or labor in different ratios than standard specifications. The calculation compares actual mix quantities to standard mix proportions at total actual input levels. AT isolates composition effects from efficiency. By holding total input constant, mix variance focuses solely on the relative distribution of components rather than total quantity used. Operational causes may include substitutions or shortages. Variances can result from material availability issues, cost-saving substitutions, or process changes affecting the standard combination of inputs. P. Calculate and explain a yield variance. Yield variance measures output efficiency from total inputs. It reflects the difference between actual output achieved and expected output based on total input quantities used, valued at standard cost per unit. IT captures productivity performance. A favorable yield variance occurs when output exceeds expectations given input levels, indicating efficient production. An unfavorable variance signals waste, spoilage, or operational inefficiencies. Yield analysis supports process improvement. Identifying root causes such as machine inefficiencies, quality problems, or inadequate training helps management improve conversion efficiency and cost control. Q. Apply price, efficiency, spending, and mix variances in service and manufacturing contexts. Variance concepts extend beyond manufacturing. In service organizations, labor rate and efficiency variances can measure consulting hours, healthcare staffing, or airline crew utilization. Revenue price variances apply to service pricing differences. Spending variances measure cost control effectiveness. For example, utility spending in hospitals or advertising expenses in service firms can be evaluated against budgeted standards. Mix variances apply to service offerings. A shift in customer service types or billing categories affects profitability similarly to product mix in manufacturing, supporting broader managerial analysis. R. Analyze factory overhead variances. Variable overhead spending variance measures rate differences. It equals actual variable overhead minus actual activity times standard variable rate, reflecting price changes in indirect materials or utilities. Variable overhead efficiency variance measures usage differences. It equals actual activity minus standard activity allowed times standard variable rate, indicating operational efficiency in using the allocation base. Fixed overhead variances assess capacity management. The spending variance reflects budget control, while the production volume variance measures under or overutilization of planned capacity relative to applied overhead. S. Analyze variances, identify causes, and recommend corrective actions. Comprehensive variance analysis requires root cause investigation. Managers must distinguish controllable factors, such as inefficiencies or purchasing practices, from uncontrollable factors like economic shifts. Interrelationships among variances must be considered. A favorable price variance may cause an unfavorable efficiency variance if lower quality materials increase waste. Holistic evaluation prevents misleading conclusions. Corrective actions improve performance. Recommendations may include renegotiating supplier contracts, enhancing employee training, revising standards, improving production processes, or adjusting pricing strategies to restore alignment with objectives.